Hi! This video contains two lessons, which are solver and income statement analysis. Solver is always useful when facing constraints or having limited resources, and solver can provide the optimized solution for sufficiency. In business, the optimal goal is to maximize profit, and by using solver, company can benefit from using limited resources to effectively maximize profit. So let's get started with solver. In order to do solver, we need to have three components. The first one is the revenue. This is the optimum goal that we are seeking for. It's highlighted in light purple right here, and this is a formula based. It's calculated by using the total number of the total units that we're gonna make for each product, multiplied by the unit revenue, which is down here, and then we just add all the revenues from all three product lines. And then the second component is the number of units that we're gonna make for each product line, which we're gonna use solver to help us to solve or to maximize our revenue. And this is also based on the resources available for us to make. And then we also have the used column, which is calculated by using the total number of units that we're gonna make multiplied by the required resources for each unit. So for example, each bicycle requires 2 tires, 1 hour of labor, 3 pounds of steel, 3 pounds of aluminum, and then 2 pounds of plastic. Okay, so let's do solver. So go to data, solver. We need to set our objective, which is our total revenue, our optimum goal. And we need to set it to maximize. We want it to be maxed. And then by changing variable sales, which is these lines, these 3 cells, those are the number, those can be changed. And then subject to constraints are the columns over here. It's E13 through E17, and we want it to be less than what is available. We do not want to go over it, so it's like less or equal to what is available. And then we click solve. And okay, so there we go. So we can make 3,120 bicycles, and 1,840 strollers, and 800 toy cars. And by making those, we can maximize our revenue with those limited resources. So with the solver, we can forecast our income statement. So as one of the important financial statements of a company, income statement is a useful tool in the decision-making process because it can provide a thorough understanding of a company's profitability, operation, and liquidity by using ratio analysis. So this video shows income statement for each of the products and the aggregate level. So after we come up with the number of units to make, we can estimate what the revenues are, what the expenses, the cost of goods sold, and other operating expenses. So the unit revenue is basically what we have up here. The unit revenue is the same. It's all crossover. It's crossover. And then this is just the total, the sum of all those the 3 products. And then we have the unit cost of goods sold is 40 for bicycle, 50 for stroller, and then 100 for toy cars. And then we come up with our profit, which is revenue minus the cost of goods sold. And then down here we calculate our total revenue, which is using the total units that we're gonna produce, these numbers are coming from what we from the solver. And then this is just using the total units that we're going to produce multiplied by the revenue. And this, the cost of goods sold, is the same total products, total units multiplied by the unit cost of goods sold. And then we come up with this total profits for each product line. And of course, when we're in business, we would incur expenses such as selling, general and administrative expenses, rent expenses, and research and development. So SG&A expenses are $60,000 for bicycles, $65,000 for strollers, and $80,000 for toy cars. And then rent and facility, since they're gonna use the same facility, the 1 year total rent is $18,000. And then we're gonna divide it among the 3 products. So we're using this total divided by 3, and that's where we come up with the $6,000. And then research and development is $35,000 for bicycles, $30,000 for stroller, and $50,000 for toy car. And that's our operating expenses. And after the operating expenses, we have the operating income. So it's the total gross profit minus what we have in operating expenses. So as of now, up until toy cars are operating at a loss, whereas the other 2 are operating in creating incomes. And further than operating income, we still have interest expenses and tax. Interest expenses we incur as a startup. We don't have much equity as the other companies, so we have to borrow money from the bank, and that would incur interest expenses. And for the bicycle line, we incur $25,000 of interest expenses, and stroller we incur $30,000 and $40,000 for the toy cars. And then that would give us the income before tax, which is the income before interest and tax minus interest expenses. And then we are going to estimate our tax expenses, which is estimated to be 35%, which is the highest rate in the United States. So this is the income before tax multiplied by 35%. And that would give us the net income, which is income before tax minus the income tax portion. So we'll have a net income of approximately $80,000 for bicycle, $34,000 for strollers, and we have a loss of $36,000 from toy cars. And ratios, the bottom here shows 2 ratios that could help us analyze the financial statements. And these 2 ratios are profit margin and operating margin. Profit margin is calculated as total profit over total revenue. If you see the formula, is total profit 80 over the it's actually the unit profit over the unit revenue. That would give us the profit margin of each product. And then the operating margin is calculated as the total operating income over the total revenue that we have. So the profit margin indicates the true profit after subtracting cost of goods sold. And according to this analysis, bicycle for kids and strollers have the highest profit margin of 66.67%, and toy cars have a 60% profit margin. Although profit margin is high for 3 products, it doesn't mean they create income, so we need to further analyze the income statement. Operating margin can provide a deeper understanding because it takes into consideration other expenses that incur during the during the period, such as all the expenses here. And in the By Troy Manufacturer Inc., Bicycle for Kids still has the highest profit margin of 36.9%, which means the expenses are under control and operating efficiently, whereas the toy car has a negative 8% operating margin, which indicates that the expenses are too high and they're hurting the profit. Thus, management need to either cut down expenses or increase the profit margin in order to create income for this product in the future. And that's the end of our video. Thanks for watching.